Hello, everyone. Welcome to this episode of the Tax Bite podcast series. In this episode, we will talk about Amount B of Pillar 1. It's been a long time that we have spoken about Pillar 1, but there's a lot of updates going on, so it was a good momentum to have this podcast. My name is still Peter, and I'm welcoming Stefan, Gilles, and Jens in my recording studio. Stefan is well known for all of you. He speaks frequently in this podcast. For those who are still new to the podcast, Stefan is actually a senior counsel in our team. He's former part of the Belgian tax administration, and he has spent several years at the OECD. He's the true expert here to talk about a lot of these developments. In addition, we have Gilles. Gilles is director in the transfer pricing practice with a particular focus on, amongst others, business transformations. And I'm also welcoming Jens. Jens is also a director in our team, and he has been assisting M&Es in all kinds of transfer pricing matters for over 10 years. He's also closely monitoring all these developments in the context of the OECD Pillar 1, Amount A and B. So with this audience, I have the perfect group of people to talk about Pillar 1, Amount B. It has been quiet a little bit on Amount B and Pillar 1 in general, I think, and Pillar 2 was taking over. But now Amount B, a paper came out in July, and we want to talk about this in the podcast, not only because this paper came out, but also because in the past months we have had several discussions with clients on this topic, and we want to share a little bit about that. Perhaps, Stefan, can you recap a little bit what Amount B means?
Thank you, Peter, and a good day to all of you. Yeah, just to set the scene a bit, and Peter already referred to the two-pillar approach, Pillar 1, Pillar 2. Pillar 2 is about a minimum tax of 15%. We all know that, and that's not in scope of the discussion today. So today we're going to talk about Pillar 1. Pillar 1 consists actually of two different legs, Amount A, which is a redistribution of profits, and Amount B, which actually is trying to calculate the standard return for in-country baseline marketing and distribution. And that is the topic of today. When we talk about Pillar 1 Amount A, when we talk about Pillar 2 Amount B, we have certain thresholds that needs to be passed. Well, I can already say, and we will address it further into this podcast, that is not the case for Amount B. All multinational enterprises may come in scope of Amount B. It should cover relatively simple marketing and distribution activities. Why? Well, because such activities, in practice, it has been shown that they populate a large part of the controversy files, so including mutual agreement procedures. It also should give attention to the needs or difficulties of developing economies which struggle with real transfer pricing, so giving it a kind of certainty, giving it a kind of simplification, and that's precisely the aim of Amount B. The goals are actually simplification of transfer pricing of relatively simple activities, trying to streamline those activities and enhancing tax certainty, so avoiding actually disputes between tax authorities and taxpayers, but also amongst tax authorities themselves. I already mentioned it relates to simple marketing and distribution activities. We will address that further in the podcast today. And so in the statement, the inclusive framework statement of, let me take us a year or two back, in October 2021, there was an agreement on the two-pillar solution, including Amount B as part of Pillar 1. It was called at that time a critical component. There was further work being done, and there's a public consultation document that was published in December of 2022. It received quite some comments. Also, I could say quite some negative comments because, for example, the scoping criteria were way too difficult. And these comments actually led to a new public consultation document, which you refer to in July 2023. It allowed scoping, but still there are some, and we will address this further in this podcast, still some uncertainties, for example, on certain definitions. There are still some unclarities in there. It's not fully elaborated, we think. But that's the main purpose of this document, getting in comments with a deadline of the 1st of September 2023. Why are there still controversies and non-elaborated issues in there? For example, a spillover effect to customs. This deals with baseline marketing and distribution, direct taxation, but there is no word with regard, for example, spillover effects to customs or VAT or other taxes. Our customs may be because the OECD is not competent for customs, but there should be, I would say, then a relation with, for example, the World Customs Organization. The plan is to publish Amount B as part of the OECD transfer pricing guidelines by January 2024. So you could almost say this is the day after tomorrow. As I already indicated, it's two legs on the one pillar. It's technically separate. You could easily actually divide Amount A from Amount B, but they are politically linked. They are very much politically tied. There is interdependence between Amount B and the signing and entry into force of the multilateral convention with regard to Amount A. Again, here is the political link, but it is still unclear how those links actually will look like. They could technically still be introduced separately, and it is certainly disconnected from Pillar 2. What is indicated in actually the joint statement of the inclusive framework is that they will give the time necessary to countries to adopt legislative changes if needed, and to give effect to the revised transfer pricing guidelines. So what we should do is actually get prepared. They also invite business to be prepared, and be prepared. That's our ask, because application could be imminent, perhaps already in 2024.
But Stefan, I hear you say that all of this is embedded in the OC transfer pricing guidelines. So yeah, it's soft law. How big of an impact does this actually have on companies?
That's an excellent question, Peter, and the impact can be quite broad. And the transfer pricing guidelines are soft law. It's not really binding. It's guidance. Countries and companies can rely on it, but it's not binding. However, what we see at the level of the OECD and the inclusive framework is that these kind of soft law mechanisms, or what they develop, becomes hard law. So I would say this is a kind of hard soft law. The OECD guidelines in certain countries, they have a direct effect. In particular, when there is, when the transfer pricing guidelines are embedded in domestic legislation, they can have a direct effect. Other countries have, for example, like Belgium, like Netherlands, they don't have it embedded, but they refer to the transfer pricing guidelines, so making it easier. So it will depend, and there can also be mismatches where when you need legislative changes, where there can be a delay actually in application of these new guidelines. Others, for example, like Belgium, they can say that the guidelines have changed. We're going for a dynamic approach in the application, so we're going to apply it directly. This also relates to treaty application, whether the OECD guidelines would apply. So be careful. It's soft law, but as I indicated, it can be hard soft law. The impact can be quite big.
Okay, yeah, thanks, Stefan. So yeah, if I hear you well, Amount B will have an immediate impact actually, as from January 24, which, as you said, is the day after tomorrow in a way. So let's dive a little bit deeper now in how that Amount B will actually work. And Jens, is that something you can talk us through?
Sure, Peter. Thanks. To explain how Amount B would work, there are two important items I would like to discuss. The first one is which groups and transactions are in scope. And the second one is how the arm's length return for baseline marketing and distribution transactions would be determined. To start with scoping, first of all, it is relevant to highlight that amount B could apply to all groups, irrespective of their size, because there's no revenue threshold as we know it for amount A under Pillar 1 and for Pillar 2. The type of transactions which are targeted are so-called baseline marketing and distribution transactions, as Stefan already mentioned. Now, what is meant with this term are, on the one hand, buy-sell marketing and distribution transactions, where the distributor purchases goods from an associated enterprise for distribution to unrelated parties. But on the other hand, also sales agency and commissionaire transactions, where the sales agent or commissionaire contributes to the distribution of goods to unrelated parties by an associated enterprise. This means that where there was still a lot of discussion on the restrictive scoping in the public consultation of December last year, now commissionaires and sales agents will also be included next to buy-sell, or as we often call it, limited risk distribution transactions. For both buy-sell and for agency commissionaire transactions, it is important that only wholesale transactions would be in scope, so retail is excluded. Then what should happen to determine whether the buy-sell or the sales agency or commissionaire transaction is actually in scope is to assess whether it meets a number of additional scoping criteria. The OECD has defined two alternatives for the additional scoping criteria in the current public consultation document, Alternative A and Alternative B. Both alternatives would firstly require the qualifying transaction to be able to be reliably priced using a one-sided transpricing method, being the transactional net margin method. And secondly, also required that the party not to incur annual operating expenses to annual net sales outside a certain range. Depending on the alternative, the range goes from 3 to 30 or to 50%. The main difference between both alternatives is that Alternative B will also require a third and separate qualitative scoping criteria to identify and exclude what they call non-baseline contributions. Examples of those non-baseline contributions referred to in the public consultation document include situations where the distributor makes contributions with respect to customization or modification of products for third-party customers, as well as situations where the distributor makes specific contributions beyond a mere facilitating role that enable market access for the products to be sold to third-party customers. And then finally, with respect to the scoping of Amount B, I would like to mention that there are exclusions for services and for commodities. You can imagine that this may raise difficulties in situations where the distribution of goods and services is combined, but also with respect to commodities, what should exactly be understood by that term. What is currently still up for discussion is whether digital goods, like the sale of movies, music, or software, would ultimately be in scope or not.
Okay, thanks, Jens. So to recap, I will attempt to make a short recap. Transactions that would be in scope are buy-sell, commissionaire or agency transactions. They would cover wholesale activities, and an assessment should be made about the baseline character based on certain additional scoping criteria. And there are certain exceptions for services and commodities.
Yep, exactly. That's a perfect summary, Peter. So currently, Amount B is limited to those type of baseline marketing and distribution transactions, but we'll come back in a few minutes on what some say about potential spillover effects this may have for other types of transactions somewhere down the road. Now, I said I was going to talk about two key items in respect of how Amount B would work. We already discussed the scoping. So the second item is the determination of the arm's length pricing under Amount B. The deemed arm's length return for in-scope transactions of Amount B would consist of a fixed return on sales. And interestingly, a specific percentage of return on sales would apply irrespective of whether it is a buy-sell transaction or an agency or a commissionaire transaction. The fixed return on sales should be derived from a pricing matrix, which has been derived by the OECD from a global benchmarking data set of companies involved in baseline marketing and distribution activities. And as you can see in the consultation document, the exact pricing point would be determined depending on the combination of three factors that apply to the tested party of the in-scope transaction, being one, which industry does it belong to? Two, which operating asset intensity does it have? And three, which operating expense intensity does it have? And it will be the combination of those three factors that will determine which return on sales should be attributed to the tested party, knowing that percentages in this global pricing matrix range from minimum 1.5 to maximum 5.5%. The OECD has also foreseen a relatively narrow range of minus 0.5 to plus 0.5% from the fixed return on sales as derived from the global pricing matrix, within which the return of the in-scope transaction would be considered arm's length. And when the margin reported by the taxpayer would fall outside that arm's length range, it is said that tax administration should use the midpoint of that range to adjust the margin of the controlled transaction. I'm referring to a global pricing matrix here, but note that the OECD would give countries the option also to deviate from this global matrix to address geographic differences in profitability in case there are significant deviations with the return on sales derived from a local benchmarking set, or in cases where there is a high risk to operate in a given country. So in a nutshell, there would be a global pricing matrix, and groups should assess based on three factors what the fixed return on sales percentage for their in-scope transactions is, and countries may deviate from that global pricing matrix. To avoid over or under remuneration of the in-scope transaction, finally, the OECD also came up with a capping and flooring mechanism. And this corroborative mechanism would mean that the outcome of the global pricing matrix in terms of fixed return on sales should be tested against the implied level of barrier ratio, which should fall within a range of 1.05 to 1.5. For the audience, I already want to point here at the significant number of ratios that groups will need to make for their in-scope transactions. First of all, groups will need to be able to segment their financial data at entity level to isolate the part that relates to the in-scope baseline marketing and distribution transaction. And secondly, groups will also need to compute a number of ratios such as operating assets and expense intensity, return on sales, and barrier ratio. And as always, this could lead to a lot of definitional questions and practical issues in terms of financial data segmentation. I'm sure many of our listeners can think of examples such as entities with a mixed functional profile, entities which have both wholesale and retail distribution transactions, or entities which perform distribution transactions partly for goods in scope and partly for goods and or services out of scope of a MANB, which can really make it difficult to calculate all these ratios.
Okay, thanks, Jens. So if I hear you well, this presents in many cases quite a change compared to how companies are currently dealing and remunerating distribution activities. So Gilles, looking at this from a broader transformation perspective, how do you see then the impact for the broader multinational companies?
Yeah, so if we look at the different ways Amount B may have an impact on companies, I would actually break it down into three main buckets. So bucket one being, how it may impact the tax model, where the main areas of tax which would be affected are obviously transfer pricing, but also customs. The second bucket would be around compliance. So that ranges from how you set stuff up in your ERP system to how you describe certain things in your transfer pricing documentation and your contractual framework. And then the third bucket would be around controversy. So how do you deal with audit defense in basically a new world where your discussions may start trending towards more of a debate on method selection rather than sort of benchmarking. So is it amount B versus is it a profit split? This may also then have a knock-on impact on decisions on actually seeking advanced certainty in transfer pricing and customs.
Okay, 3 areas of impact. It will be helpful for the listeners, I think, if we cover them one by one. So Gilles, can you give us a bit more detail on the first bucket, the tax model impact?
Yeah, sure. So if we look at how amount B may affect the tax model, I again find it helpful to break this down into a few different groups of companies which may be affected. And a first distinction, I believe, can be drawn based on the scope, which Jens explained. So on the one hand, you have companies which are just squarely within the scope of amount B, directly impacted by these new rules. On the other hand, you have those companies which aren't in scope, but they may still be facing an indirect impact from the amount B rules. So for example, companies selling services. So if we start maybe with the first group, so the ones which are within the scope of amount B, there's again a few ways in which that group can be broken down further. And talking to quite a few companies on the potential impact of amount B over the past weeks, months, one of the key distinguishing parameters within that group is actually whether you're operating within a high or low margin industry. And the challenges which each of those groups is facing, that might be quite different. So if we would zoom in on the low margin companies, for example, they may end up in a situation where a significant part of the system profit is actually allocated to the distribution function under the new amount B rules. So in some cases, it may actually end up in a situation that more than the system profit is allocated to the distribution function. That obviously means that you have nothing left to remunerate other activities such as manufacturing, etc., which would effectively result into double taxation. The Berry ratio overlay, which was introduced in the current discussion draft that Jens also explained as this sort of overriding cap and floor mechanism, that's definitely helpful to mitigate potential issues from that perspective, but it will still require careful modeling to see if that overlay is actually enough to safeguard profit allocation to the rest of the value chain, or if you need to look at a more fundamental redesign of your structure to deal with this new reality and avoid getting stuck in this structural double taxation position due to allocating too big a share of your system profit to the distribution function. Now, in addition to how it would affect your transfer pricing model, another critical area to consider here is how it would affect you from a customs perspective. And that's, of course, especially relevant for in cases where you're facing custom duties which are levied as a percentage of the price of the good. And the reason why customs is so relevant, while this is actually a transfer pricing guidance that we are talking about, is because in practice, and I'm just going to use LRDs as an example, but margins of LRDs are typically achieved through an adjustment in the price of the goods, which then by extension also impacts the custom duties. So having a higher margin, so seeing that increase in margin, it means that you might have to reduce the price of the goods to actually achieve getting to that higher margin. Now, custom authorities in many countries, they don't necessarily accept the use of the transactional net margin method to price goods. And there's definitely no guarantee that they will accept amount B, as Stefan also indicated at the top of the episode. So custom authorities may not agree with this reduction in prices, and that could result in them refusing refunds. So all of this may actually require companies to have a much closer look at their customs process, for example, obtain custom rulings to actually be able to get refunds in case you are reducing the price of your goods to make sure that you are compliant with the transfer pricing requirements under amount B. So if we now look on the flip side, so the high margin bucket of this group of companies, here you may have several companies which end up in a situation which might be a bit counterintuitive, where under amount B, you'd be allocating less profit to distribution activities compared to today. And the friction that might be created here is where you have a situation if, say, in your LRD country, say that country requires legislative action for these updated rules to come into effect. So they could still work under the old set of the OECD guidelines or their existing legislation and expect higher returns under the existing set of rules. While, for example, in your principal country, they have an automatic effect of these new guidelines. So they may actually expect you to apply the amount B returns and grant a lower return to the LRD country. So consequence of all of this may be that you still have to do a distribution benchmark anyway to support your position in the LRD country. And to avoid sort of that mismatch between interpretation between the two countries, it could also be an important driver to actually move towards bilateral APAs on transactions which previously did not seem that interesting to actually get upfront certainty on. If we again look at the customs angle here, so imagine a situation where margins have to go down. That means the price of the goods will go up to achieve these lower margins. So these groups may be facing higher custom charges, which is an above the line item, making it very visible on the radar of the business. And this may have to be considered in commercial negotiations. Now, maybe to come back on the second group, which I mentioned, on the companies which are not in scope of amount B, they may be facing a spillover effect. So if you read the discussion draft, the OECD has introduced several limitations in the document to say amount B should only be applied to companies in scope, which is definitely helpful guidance that is introduced there. That being said, I can easily see a world where some of the concepts from amount B are used more broadly. So not necessarily where the full amount B guidance is applied in its totality to an out of scope situation, but bits and pieces are taken from it. So for example, you have a situation now where your return on sales margins are determined based on corroborative ratios such as assets intensity, OPEX intensity. And it doesn't take much of a leap of imagination to start seeing similar discussions to distribution activities not in scope. So for example, sale of services, or maybe completely different activities, such as when benchmarking the returns for manufacturing activities. Another example are the country risk adjustments, which have been introduced where, countries which have a low credit rating, they may start expecting higher return on a broad range of activities, not just distribution. And maybe just to close off, in addition to having an application or a potential application of these concepts more broadly, you obviously now have a situation where there's a visible number of a return on sales margin out there would be introduced in the guidance. So assuming that return on sales percentage is within the TNNM range of an out of scope group, there might be an evolution in practice where you create an expectation to move towards that amount B return on sales percentage as the point to select within the range, unless of course you're able to argue why a different point is more appropriate.
Okay, thanks, Jill. So clearly a lot of impact is expected on the tax model, first bucket. I think it's time to move on to the second and third bucket now. So which was compliance and controversy. Jens and Stefan, can you take us through some of the main highlights on this one?
Yeah, sure, Peter. For me, once you have the model right, it will be important to make sure you implement it well and don't leave any room for discussion. As regards documentation, this means for me reviewing and where necessary also updating contractual frameworks, DP documentation, and of course also the calculation of relevant financial data in light of amount B. The OECD states that the current content of the OECD local file should include all information which is relevant to examine the taxpayer's position with respect to amount B, but at the same time that tax administrations may also require taxpayers to provide them upon request with additional information in the context of amount B. So this means for me that companies should better be prepared to come up with documentation that supports their position, both in terms of scoping and also in calculation of the relevant financial data for amount B.
Yeah, thanks, Jens, and thanks, Peter. This question was also addressed to me. And with regard to controversy and disputes, well, the best dispute is the one that did not happen. And in relation to that, well, I think it will be interesting to see how local country tax administrations will be willing to engage in upfront discussions or even rulings allowing taxpayers actually to obtain upfront certainty. There is some unclarity, as has been explained by Gilles and by Jens. For example, on the scope. Is a transaction in scope or not? There is quite some unclarity in there. How to apply the global pricing matrix, the point in the matrix, how to define certain data points under the relevant accounting principles, etc. So there is that unclarity still going on. So we can see already a significant increase in discussions where we had a lot of discussion in the past on the position of the benchmark. Now, what we anticipate is actually a shift of the discussion towards, are you in scope or not? Do you want more amount B return or not? So if you are not into amount B, will you apply a profit split mechanism or a two-sided mechanism? Because tax authorities cannot argue for a higher point in the range. So this is the type of, we anticipate a shift in controversy actually from a discussion on real transfer pricing onto this, I would say, side elements and non-transfer pricing. There is one certainty there, or at least one element of certainty that they give, that they say that existing advanced pricing arrangements or bilateral or multilateral advanced pricing arrangements that existed prior to amount B would not be amended by amount B. So that's a certainty. However, upon renegotiation, upon arriving at the deadline of the advanced pricing arrangement, of course, there you could say that certain countries will pinpoint to amount B. The consultation document does not refer to alternative dispute resolutions, nor to arbitration. It simply indicates that mutual agreement procedure could be applicable, but then we know that not all countries have tax treaties with each other. What is also lacking is references to, for example, the International Compliance Assurance Program, ICAP, but that is of course a European element, but perhaps more guidance can come there. The European Trust and Cooperation Approach, ETACA, which is precisely targeting cooperation with regard to low-risk activities, where we think these amount B activities fall into. So with regard to controversy, there's still a lot of uncertainty going on, Peter.
Well, thanks, Stefan and Jens, for tackling that compliance and controversy buckets. Now, obviously, a lot to say on Amount B, so this podcast will be slightly longer than the average Tax Bite podcast, but that's okay, I think, because there's indeed a lot to say. Now, before we round up this podcast, I have still 2 questions that I would like to get an individual answer from all of you on. And my first question is, what would you recommend companies to start doing now? And Stefan, I'm starting with you.
Yeah, thanks, Peter. And I have 2 points perhaps that I want to raise. The first one for our clients, for companies, is please assess whether you fall into scope of Amount B. So it could have a major impact on how you do transfer pricing, on how you tackle these issues, and including future controversy. The second one relates to TP documentation, local file, master file. Also take care of those elements to see whether you have your Amount B approach, if you fall into scope, whether that would be correct. I think that would be my 2 main points here in this case.
Okay, thanks, Stefan. Jens, what would be your answer?
Yes, what I would definitely recommend companies already now to do is to do the necessary financial modeling to assess what the impact of Amount B could bring in terms of profit reallocation and how much this could impact their current business and tax model, of course, but also because of the many potential complexities I already mentioned earlier, in particular the segmentation of financial data and the definition, calculation of all these required ratios. I think even for groups which are already well advanced in terms of operational transfer pricing and automatic data segmentation, different aspects of the Amount B calculations will be new and will definitely require diligent preparation. Moreover, the return on sales range under Amount B is also very narrow, so it will be required for companies to have very accurate processes to ensure that they stay within the range. And tying back to customs authorities don't like big adjustments, as this means that the original price wasn't a final price. So making adjustments throughout the year will be very important. And I would like to take the opportunity here to make some publicity for the Amount B tool, which our team here in PwC Belgium has built. This is actually a tool which summarizes the potential impact of Amount B from a profit reallocation and also effective tax rate perspective, both on a country and entity level, to Power BI visualizations. And the input to feed this model is Excel-based, which is also a great way for companies to already test and consider if they have all the necessary financials to make the Amount B calculations.
Okay, thanks, Jens. So, Gilles, you are the last one for this first question I had.
Yeah, for me as well, a first priority in the period between now and January, say, when these new guidance would be introduced into the guidelines based on the OECD timeline, the modeling should be the first thing that you should be doing in the period now. And based on the outcome of that modeling, you will then be able to see what are sort of your pain points as an organization and start shaping a bit of an action plan to be ready for January, covering the 3 big domains that we talked quite a bit about in the podcast today. So, your tax model, your implementation and compliance, and controversy.
Okay, thank you, Gilles. And I said I had 2 questions. So my last question for this podcast is, and I would like to get indeed also an individual answer from all of you on that one, is how likely is it now that the Amount B will actually happen? And Gilles, please continue. Let's start with you.
Yeah, so if you look at the progress which the OECD has made between the previous December discussion draft versus the one now, for me that's quite impressive how far they progressed on a lot of fairly difficult topics. We're not there yet in the current document, but if this same trend and pace of progress continues, for me, I believe that there's a decent likelihood of it becoming a reality in January, actually.
Yeah, I tend to agree with that, Jill. There's two things I would like to add in that respect. First of all, in my view, Amount B can only work if a major number of countries, including emerging and developing economies, sign up to apply the system. Behind the scenes, we hear that certain countries, as opposed to others, are still not a big fan of agreeing on Amount B, or if it would come true, that they may not apply it in their own practice, which will of course be detrimental to tax certainty for groups which are active over there. And secondly, as the OECD wants Amount B to become effective already in a few months' time from today, and it is still unclear whether it will be mandatory or if it will operate as a safe harbor, an approach that would allow for some time to evaluate the pros and cons of the different implementation needs in practice would be to have some kind of pilot program that allows taxpayers to elect Amount B during a transitional period before actually deciding whether it will be mandatory or a safe harbor.
Yeah, thanks, Jens. Thanks, Jill. And my 2 cents would be that we would all welcome the approach with regard to enhancing tax certainty, avoiding controversy, simplification of transfer pricing. That's all very much welcomed. Simplification leads to more certainty for taxpayers and tax administrations, or between tax administration amongst themselves. I think as my main takeaway is that the new discussion draft tries an attempt of reaching that enhanced solution, but we are not there yet.
Okay, thanks, Stefan. I think that ends this podcast on Amount B. There was quite a lot to say about it. So I hope that the audience will appreciate that this is a little bit longer than our average podcast in the Tax Byte series. But for sure, we will come back to you if more updates come around on Amount B, but also on the other international developments, of course. For now, I would like to thank the speakers here. So Jens, Stefan, Jill, thank you very much for joining me and explaining all of this to the audience. And I thank the audience, of course, for tuning in, and hope to see you in the next episode. Thank you.